Silver gained over 150% from early 2025 to its January 2026 peak. It ran from 32 to 110 in under 12 months. That kind of move should have made everyone rich. But here's what the Silver Institute's retail positioning data actually shows. The vast majority of individual investors who participated in that rally lost money. Not broke even, not modest gains, losses. Some of them catastrophic. One investor I tracked through a public trading journal put $140,000 into silver positions between October 2025 and January 2026. By March, every dollar was gone. A metal that nearly tripled in value, and most people who touched it walked away poorer than when they started. That shouldn't be possible. And when you understand the 3 mistakes that made it possible, you'll understand something far more important. You'll understand whether you're about to walk into the same traps on the next rally, because there will be a next rally, and the same traps will be waiting. My name is Alex, and I've spent the last decade tracking commodity cycles, central bank policy, and the behavioral patterns that turn retail investors into exit liquidity. If you want to stop donating your money to smarter traders and start positioning like the 10% who actually build wealth in metals, hit that subscribe button and give this video a thumbs up. Before we dive in, I want to know, do you own physical silver, paper silver, or are you just watching from the sidelines right now? Drop it in the comments because I'm genuinely curious where this audience stands. Here's what this video is really about. It's not a silver price prediction, it's a behavioral autopsy. I'm going to show you the 3 specific mistakes that separate the 10% who build generational wealth in precious metals from the 90% who become someone else's liquidity event. And the third mistake, the one almost nobody talks about, is the reason even people who bought silver at 30 still managed to leave a fortune on the table. But we'll get there. Let me paint a picture first. Imagine you're standing in front of a slot machine. You've been watching someone else play for an hour. They've hit 3 jackpots. The crowd is cheering. The lights are flashing. And you think, this machine is hot, I need to get in now. That's exactly backwards. That's not how probability works in a casino, and it's not how markets work either. But here's the thing. When silver is grinding sideways at 28 for 6 months, nobody wants it. It's boring. Your friends aren't talking about it. Reddit isn't posting about it. YouTube finance channels are covering AI stocks or whatever shiny object is trending that week. There's no urgency, no excitement, no emotional pull. But that boring, sideways, nobody cares phase, that's when the smart money is accumulating. Quietly, methodically, without telling anyone. When the price explodes, when everyone suddenly becomes a silver expert, when your barber mentions he just bought his first 10-ounce bar, that's when smart money is selling to you. Daniel Kahneman and Amos Tversky won a Nobel Prize for documenting this exact behavior. They called it prospect theory. Humans feel the pain of a loss roughly twice as intensely as the pleasure of an equivalent gain, which means when silver is crashing, you feel compelled to sell even when the fundamentals haven't changed. And when silver is soaring, the fear of missing out overwhelms every rational calculation in your brain. You're not making a financial decision anymore. You're having an emotional reaction with a brokerage account attached to it. The system, the social media hype machine, the finance influencers with their rocket emojis, the Reddit threads full of diamond hands memes, they're all amplifying this dysfunction. They're not trying to help you time the market. They are the market. They're providing the emotional fuel that turns you into exit liquidity. And here's the part that really stings. They don't even know they're doing it. Most of them are caught in the same trap. They're just louder about it. And that brings us to the first of 3 mistakes. Pay close attention to this next part because this is where the real money is made or lost. Mistake number 1. Buying at euphoric peaks without a plan. Let me tell you a story that might feel uncomfortably familiar. It's late 2023. Silver is sitting around 25 an ounce. You notice it. Maybe you read an article about supply deficits. You think about buying some, but it's not moving. It's boring. Your portfolio notifications don't even mention it. You scroll past. Throughout 2024, silver grinds up to 40. You see it. You think, I should have bought at $25. But 40 feels expensive now. You wait for a pullback that never really comes. You tell yourself you'll buy the next dip. The dip comes, silver drops to 36, and somehow that still doesn't feel right. So you wait. Then late 2025 happens. Silver breaks 50, then 60, then 80. Reddit's Wall Street Silver Forum is on fire. Every other YouTube thumbnail has a rocket emoji and the words silver to $200. Your coworker mentions he just bought a monster box. Your uncle calls you about silver for the first time in his life, and something snaps in your brain. The FOMO becomes unbearable. The pain of watching everyone else make money is worse than the fear of losing your own. You buy at 205 an ounce. It feels safe because everyone is buying. It feels obvious because the chart only goes up. It feels like the smartest decision you've ever made. Within days, silver crashes to 82, a 22% drop. The same YouTube channels that scream silver to 200 are now posting videos titled "Silver Crash, What Happened?" with a red arrow pointing down. Panic floods your body. You sell at 85. You just locked in a 19% loss on a metal that's still up over 11-12% from where it was when you first noticed it at 40. You lost money on an asset that more than doubled. Let that sink in for a second. And here's what makes this truly devastating. This is not new. It's the oldest pattern in precious metals. In 1980, retail investors piled into silver at 45 to 50, just as the Hunt brothers were losing their grip on the market. Silver crashed 80% over the next 2 years. In 2011, retail bought at 45 to 49 right before a devastating crash that took silver below 14 by 2015. In 2026, retail bought above 100 right before the correction. Same pattern, different decade, same result. 3 generations of investors making the identical mistake. The solution isn't complicated, but it requires something most people refuse to do. You have to buy when it's boring. Dollar cost average during the sideways accumulation phase. 500 a month at 25, 28, 32, 35. You're not trying to time the bottom. You're building a position at an average cost so low that by the time euphoria hits, you're taking profits while everyone else is just arriving at the party. You're selling into the frenzy, not buying it. Now I know what you're thinking. But Alex, what if I missed the rally entirely by being too cautious? Here's the hard truth. If you can't bring yourself to buy during boring markets, you will always buy during exciting ones. And exciting markets are where retail goes to get destroyed. That's the pattern. That's the trap. And knowing it exists is the first step to avoiding it. But there's a second mistake that's even more destructive than buying the top. And it's the reason some people didn't just lose their investment. They lost everything. And I mean everything. Mistake number 2, using leverage. Futures, options, margin. A trader sees silver breaking $80 in late 2025. The momentum is undeniable. The chart looks perfect. But instead of buying physical metal, they think bigger. They go long. One silver futures contract at 95. Now here's where the math becomes terrifying. One silver futures contract controls 5,000 ounces. At 95 per ounce, that's 475,000 of exposure. The margin requirement? Somewhere between 15,000 and 20,000. That's 25 to 33 times leverage. Let me say that again. You're controlling nearly $500,000 of metal with 20,000. If silver moves 5% against you, your entire margin is gone. Not reduced, not damaged, vaporized, not damaged, vaporized. You get a phone call at 3 in the morning from your broker, and it's not a friendly call. The CFTC tracks these liquidation events, and the February 2026 crash, 27% in 3 days, didn't just hurt leveraged traders, it systematically destroyed them. Bloomberg's analysis of futures liquidations during that window showed cascading margin calls that actually accelerated the crash itself. Leveraged longs getting liquidated pushed the price lower, which triggered more liquidations, which pushed it lower still. A death spiral where the victims were also the cause. Congratulations, you didn't just lose money, you helped crash the very asset you were betting on. If you've made it this far, you're already ahead of 90% of people watching. But don't stop now because the best stuff is still coming. Here's what that trader could have done instead. Take that same 8,000, buy physical silver at 80 an ounce, that's 100 ounces, real metal, in your hands or in a vault with your name on it. When silver crashes to 82, you still own 100 ounces. You're down 2.5% on paper. You haven't been liquidated. You haven't received a margin call. You haven't lost your brokerage account. You haven't lost your house. You just own metal. And there's a psychological dimension to physical ownership that most people completely underestimate. When you hold physical silver, you can't panic sell at 2 in the morning with one click. There's friction. You have to find a buyer, arrange a transaction, physically move the metal. That friction is a feature, not a bug. It protects you from yourself during the exact moments when your judgment is most compromised. Nassim Taleb said it best. To succeed, first survive. Leverage is the opposite of survival. It's paying for the privilege of being destroyed by ordinary market volatility. A 27% correction in silver isn't a black swan event, it's Tuesday. It happens in every single bull market. If your strategy can't survive a 30% drawdown, it's not a strategy. It's a prayer with a brokerage account. If you refuse to buy physical, at minimum use unleveraged vehicles, the Sprott Physical Silver Trust or SLV, accept smaller position sizes, accept slower gains, because the alternative isn't smaller gains. The alternative is total loss. But here's where it gets really interesting. Because mistake number 3 is the one that catches even the smart investors, the ones who bought low, the ones who avoided leverage, the ones who did almost everything right and still left a fortune on the table, or worse, turned a winning position into a panic sale. Mistake number 3, no exit strategy. Let me tell you about an investor who did everything right. Mostly. They bought silver at $30 in late 2024. Disciplined accumulation, no leverage. 100 ounces of physical metal, 3,000 total investment. Beautiful entry. Textbook patience. Silver rallies to 110 by January 2026. Their 3,000 position is now worth 11,000. A 267% gain, on paper. Here's the problem. They have no plan. No written framework for when to sell. No predetermined profit targets. No line in the sand. Just a vague feeling that silver is going to $200 because that's what everyone online is saying. So they hold. Then the crash happens. 110 becomes 95, becomes 90, becomes 85, becomes 82, that 11,000 peak becomes 8,200. And now greed flips to fear. Instantly, like a switch. What if it goes to fear? Instantly, like a switch. What if it goes to 50? What if the whole rally was fake? What if this is 2011 all over again and silver doesn't recover for a decade? They panic sell at 85, locking in an 83% gain. Which sounds good until you realize they watched 267% evaporate to 83% because they had no plan, no system, no rules, just emotions pretending to be strategy. Morgan Housel, who wrote The Psychology of Money, calls this the gap between getting wealth and keeping wealth. Getting rich requires optimism, conviction, and risk-taking. Staying rich requires the exact opposite. Paranoia, humility, systematic rules that override your feelings. The solution is a tiered exit strategy written before the rally starts, and I mean physically written down, on paper. Taped to your wall where you can see it when the euphoria is screaming at you to hold and the panic is begging you to sell. Here's what it looks like. During the accumulation phase, 25 to 40, you dollar cost average. You buy 500 a month. You build a position of 100 to 200 ounces and you don't think about selling, not once. During the bull market phase, 40 to 80, you hold your entire position. You do nothing. This is the hardest part because you'll be tempted to take profits too early and everyone around you will be telling you to sell. Resist. During the euphoria phase, 80 and above, you execute your predetermined plan. Sell 20% at 80. Sell 20% at 100. Sell 20% at 100. Sell 20% at 100. Hold the final 40% as a core long-term position. During the correction phase, you do nothing. If you've already taken profits according to your plan, the crash doesn't hurt. You've already banked gains. The crash is just noise. Let me show you the math, because the math is beautiful. 100 ounces bought at 30. Total cost, 3,000. You sell 20 ounces at 80. That's 1,600 back in your pocket. You sell 20 ounces at 100. That's 2,000 back. You sell 20 ounces at 100. That's 2,000 back. You sell 20 ounces at 120. That's 2,400 back. You're still holding 40 ounces at 90. That's 3,600 in metal you own free and clear. Total return, 9,600 on a $3,000 investment. A 22% gain. Realized, secure, in your bank account. Compare that to holding everything through the peak and sitting at 9,000 at 90. That's technically 200%, which is close on paper. But psychologically, watching 11,000 drop to $9,000 is devastating. It feels like you lost $2,000 even though you never actually had it. And most people don't hold through that. They crack at the worst possible moment and sell near the bottom. The systematic seller sleeps at night. The holder without a plan stares at the ceiling doing math at 2 in the morning. Now let me tie all of this together because when you see how these pieces connect, everything changes. The real magic happens in your brain. This isn't really about silver at all. It's about the operating system running between your ears. Every single one of these 3 mistakes is a psychological failure dressed up as a financial one. Buying at euphoric peaks is a pattern recognition failure. Your brain evolved to follow the herd because on the African savanna, the crowd running in one direction usually meant survival. But markets are the one environment where following the crowd consistently destroys you. The crowd is right during the trend and catastrophically late at the turn. Using leverage is a dopamine failure. The possibility of outsized gains triggers the same reward pathways as a slot machine, and that's not a metaphor. Neuroscience research has shown that anticipated financial gains activate the nucleus accumbens, the same brain region that lights up during gambling. The 25-to-1 leverage ratio on futures contracts is designed to be irresistible. It exploits your brain's inability to properly assess tail risk. Having no exit strategy is an emotional regulation failure. Your prefrontal cortex, the rational planning center of your brain, literally goes offline during periods of extreme fear or extreme greed. The blood flow shifts to your amygdala, your fight or flight center. You're not thinking anymore, you're reacting. And reactions in financial markets are almost always expensive, which means the solution isn't willpower. Willpower is a depletable resource, and markets will always outlast your discipline in the moment. The solution is building systems that function even when your emotions malfunction. Write the plan before the rally. Automate the accumulation. Set the sell orders in advance. Remove yourself from the decision loop at the exact moments when your judgment is most compromised. Here's a hard truth that might sting a little. If you can't follow a written plan mechanically, you shouldn't be investing in volatile assets, period. That's not an insult, it's a survival strategy. It's self-awareness applied to portfolio management. Jack Schwager interviewed dozens of elite traders for his Market Wizards series. The one common thread wasn't intelligence, access, or capital, it was discipline. The ability to execute a predetermined plan regardless of how they felt in the moment. Every single one of them had a system. Every single one of them followed it. So let's bring it all together. The three mistakes are really one mistake wearing three masks. The mistake is letting emotions drive financial decisions in a market specifically designed to exploit those emotions. The 90% who lose buy at tops because euphoria overwhelms analysis. They use leverage because greed overwhelms caution. They have no plan because confidence overwhelms discipline. The 10% who win accumulate during boring sideways markets while everyone else is distracted by whatever is exciting that month. They buy physical or unleveraged vehicles because they prioritize survival over maximizing gains. And they follow a written, systematic exit plan because they understand that their own psychology is the single biggest threat to their wealth, not the market, not the Fed, not manipulation, their own brain. Remember the slot machine I described at the beginning? The crowd cheering, the lights flashing, the overwhelming feeling that you need to get in right now before you miss everything. You're not standing in front of that machine anymore. You've walked behind it. You've seen the wiring. You've seen the odds printed on the circuit board. You understand that the lights and the sounds and the social proof are all designed to override your judgment, an understanding that changes everything. Silver is going to be volatile again. There will be another rally. There will be another crash. There will be another wave of YouTube thumbnails with rocket emojis and price targets that make your pulse quicken. And when it happens, the same three traps will be set in the same three places, baited with the same emotions. The question isn't whether the traps exist. The question is whether you'll walk into them eyes closed, wallet open, plan non-existent, or whether you'll step around them with a written strategy, an unleveraged position, and the discipline to execute when every fiber of your being is screaming to do the opposite. 10 years from now, you'll look back at this moment as one of two things. Either the point where you finally stopped being exit liquidity and started thinking like an investor, or just another video you watched before making the same three mistakes all over again. The person you're becoming starts with what you do next. Silver, gold, the Fed, futures markets, investor psychology, commodity supercycles. What's the topic you want me to break down next? Drop it in the comments, because every single one of these videos starts with you telling me what keeps you up at night, and that's exactly what this channel is for.